Alrighty, hello everyone. Welcome to Fireside Chat number 3 with Mike Moore. This is the third in a series. We're not sure how many there's going to be, but we're rolling with it. So this time we're talking about utilizing risk management and insurance to support CCUS project enablement. And we have our guests from Marsh McLennan and Hunton Andrews Kurth. Thank you very much for joining us. So just a little bit about our program. There we go. I'm Michelle Littlefield. I'm a program coordinator with USCA. So we're a nonprofit, non-lobbying organization. And next year, 2024, will be our 100th anniversary. So we've done work in over 100 countries with USAID, the State Department, and the Department of Energy. So the Department of Energy, Fossil Energy, and Carbon Management supports our specific program. We call this Consensus for short. So it's a cooperative agreement. Our mission is to educate the public, policymakers, industry, stakeholders, anyone who would like to know on CCUS and carbon management technologies. We do this with public webinars, monthly educational briefings, workshops, technical reports, and a bi-monthly news clips of CCUS and anything related to carbon management, rare earth elements, critical minerals, blue hydrogen, environmental justice as it relates, and tribal energy, and anything else related to carbon management. So if you'd like to join, feel free to send me an email to the address at the bottom of your screen. So throughout, we won't have any presentations today. This will be more talking points. If you have any questions, please use the Q&A button and we'll answer them when the time is right. So this webinar will also be recorded and posted to our webpage as well as our YouTube page. But we do really appreciate you joining us live and having your questions. So with that, I'll pass it over to Mike Moore.
Michelle, thank you very much, and good afternoon to everybody that's taking the time to be part of this with us. We've got a pretty good group of folks here that know quite a bit about what's going on in Class 6 and primacy and policy, regulations, legislation that's out there, and also the area of ensuring the risk wrapped around CCUS, CCS, and all the moving pieces to that. It's a very dynamic space. People that are in it can tell you firsthand. It's also expanding daily. The money that's being offered from the federal government and then there's state incentives as well, and even some industry pieces is massive. And so with the massive incentives come a massive amount of participation. And of course, the tail end of this, which is probably the biggest piece of the whole equation, is managing the risk associated with this. There's the financial risk that Wall Street likes. There's the operational risk that the folks that provide specialized services like, and then there's the overall risk of any of the moving pieces that need to have some kind of protective cover. And that's where Marsh comes in with their wide suite of insurance products and risk management tools. And so between Fred and his work and Mike Bruce and Jim Walsh and Patrick Brown from Marsh, I think we're going to have a lot of bases covered. And I'm willing to bet that the next hour and change is going to go pretty quick. What I'd like to do is start with Fred and have each one of you gentlemen introduce yourselves to the folks that we do, that have not yet met you before. And kind of when you're done with that, then we'll start with Fred and go into the front end piece and then move into the insurance piece with Mike and Jim and Patrick, and in kind of a general catch-all right after that. So with that, Fred, I'm gonna let you introduce yourself. You're on mute.
All right, thanks very much, Mike. I really appreciate the invitation, and thanks to USEA for having this entire series, not just this event. I'm very pleased to be on this panel with Marsh, who is really the leading entity in the insurance industry with respect to CCUS. And I'm also pleased to be doing this with Mike, whom I've known for a decade or more, working in and around the CCUS circles. We've done a lot of work together on these issues. I'm Fred Eames with Hunton Andrews Kurth. We're an international law firm. I've been working on CCUS issues for 15 years now. Our firm is largely focused on energy and environmental issues. And so this is really nothing new for us. We have been working on it for quite some time. Prior to joining the firm, I was a counsel on Capitol Hill, where I worked on energy and environmental issues. But one of my first forays into CCUS was on the issue of risk management about 15 years ago. And so that's been a focus during that time. Happy to be here and happy to have the opportunity to present.
Great, thanks, Fred. Jim Walsh here, part of Marsh McLennan. Really excited to participate in this session. Had the privilege of working with Mike and Fred and collaborate with Fred on a number of active projects. So I think you're speaking to a really credentialed group of folks here. But Marsh McLennan, a little background on us. So we are the largest insurance broker, risk advisor in the world, servicing over 3,000 energy clients, and we service CCUS out of our energy practice because candidly, some of our clients have been doing this for 40 plus years on the capture and transport side. As sequestration is moving to commercialization and many projects advancing after the IRA, I co-lead along with Mike Bruce, Marsh's CCUS practice. And we're actively engaged with over 50% of projects as defined by the Clean Air Task Force. Our role thus far has been project enablement. We've worked with a number of firms on the Class 6 permit process and overall risk management. And as Fred mentioned, really excited to participate in this session today. Mike?
Yeah, Mike Bruce, co-lead the carbon capture team with Jim Walsh. Really excited. It's been a lot of momentum in the space. It's been really exciting to see on our end. Kind of the nexus of this call is some of the work that we're doing to support project enablement, whether that be cost containment or balance sheet protection. I think that there are a lot of good tools, widgets in our resources that can be utilized. One of those being Patrick Brown and his team, which I'll let him introduce himself.
Hey again, and thanks Mike, and thanks Michelle for hosting us. And hey everybody, so Patrick Brown, I'm part of Marsh's transactional risk group. We do a couple of things, primarily reps and warranty insurance and then tax insurance. So I am part of the tax insurance group. I was a tax practitioner for over 20 plus years. Please don't leave the seminar just yet. Please stay on. Joined Marsh a few years ago. We work on placing a number of different types of tax risks, including now a lot of the green energy. So this is the carbon capture credits that have been enhanced and other credits that were created as a result of the Inflation Reduction Act this last year. So happy to be here, and I guess we'll get started in just a moment. Thanks again.
Yeah, we'll and Patrick, thank you, and guys, thanks very much. Hot topic, a lot going on, and it gets bigger every week. So I think we'll do, like I said before, we'll start with Fred. And before I go there, I want to throw something out there. Next week, we've got a webinar with Patel on de-risking CCUS, but it's more from the different angle of where Patel and the deep technology work and groundwork is done. And again, May 23rd, it's on our website. So this is kind of a great segue for that one, for those that are kind of getting into some of the operational nitty-gritty on the de-risking side. Fred, you are the chairman of the CCUS Commercialization Consortium's Legal and Regulatory Committee. I think that group's down in Houston. I understand that the committee members' top priority issue last year was CCUS risk management. Could you talk a little about the consortium and what it is and what its purpose is, and why you think risk management pulled as the top issue with the group, and what work the consortium has done on that issue?
Sure. First, I want to note that everybody else on this call is in the beautiful sunny outdoors with their background here. I'm calling in from an undisclosed location. So in case anybody's after me, I'm not going to reveal where I am at the moment. But in any event, the CCUS Commercialization Consortium, love to talk about that. So let me back up. The National Petroleum Council was asked by the Secretary of Energy back in 2017 to put together a report on CCUS. And they issued that report in 2019. And that report, Meeting the Dual Challenge, has really been, I would say, the most comprehensive look at CCUS, what needs to be done to commercialize it. And actually a number of those recommendations have already been put into action, in part by Congress and some by the industry. The Department of Energy funded the CCUS commercialization consortium to do some work to kind of keep the job going, take those recommendations that came out of this Federal Advisory Committee's work and put them into action. And so the Southern States Energy Board and the University of Houston together run and administer this organization. We've got 3 subcommittees, one that looks at financing, one that looks at public participation, and the one that I lead deals with legal and regulatory issues. So obviously, we're going to look at legal and regulatory issues. The first thing we want to know is for the members of this group, and by the way, it's a voluntary organization. There's no cost to be part of it. But in any event, we polled our members and said, what are you most concerned about? What's the biggest issue? And the answer that poll number 1 was risk management. We want to know what we don't know about this arena. And I think to people who have been working in this arena for a while, the risks are understood, but we have a lot of people who are entering into it that maybe don't know as much about it and don't have a real handle on the risks. So when we looked at that, when we looked at risk management, we thought, okay, we need to break this down. What are the elements of risk management? Well, what are the risk pathways? Okay, and what are the other issues surrounding it? So the first thing we did was look at geology, okay, and regulatory requirements about what you have to do to get a carbon storage site approved in the first place. Okay, so we did that. The next thing we looked at was if something should happen at a facility, how are you going to manage the risk at that facility? How much is it going to cost if something does happen? Okay, so that's risk valuation. And on the third element, or the third element really is how are you going to manage that risk? You have requirements under the an underground injection control program, which regulates carbon dioxide injection, to have financial assurance available in case something does happen. So to understand what the market is looking like on that, we reached out to Marsh, and we've had a really great and collaborative relationship with them, and I'll let them talk about the details of that, but just to go through the other 2 first real quickly. So when we look at risks for Class 6 facilities, again, the first thing you got to understand is that the Class 6 regulations for Class 6 carbon sequestration sites are pretty robust. Okay, you have to have a facility or a geologic storage formation that is going to contain the CO2 for long term. And that means that you've got to be able to put the CO2 in there in the first place. And second, that it's not going to go anywhere. You know, you have to check for faults, fractures, any sort of penetration that might provide a pathway for the CO2 to escape. Now, the purpose of the underground injection control program is to protect drinking water, underground sources of drinking water. But if it's going to go to, if it's going to escape, it's going to have to go through the drinking water before it would go out into the atmosphere, or it would have to go through upper layers, let's say, maybe drinking water. So, in any event, it's not going to get to, if the underground injection control program is a good proxy for not having leakage to the surface, right? So we looked at those regulations. They're very robust. Not only the siting in the first place, but also the operation, the maintenance, the monitoring, the reporting. All those aspects of it are very robust. In fact, in some elements more robust even than the hazardous waste disposal requirements under a different section of the underground injection control program. So we looked at that. And also, the University of Texas has a program that they're working on right now to say, even among those sites that we know are good, how do we know which ones are even better? Because if we can look at some elements that might show that a site is even better, maybe that'll help people in terms of, keeping community concerns low about injection of CO2, lower your risk management instruments, make it easier to get permitting if you know you have a really, really premium site. So the University of Texas is working on, I guess I'd call it a rubric with respect to that. Then we talked to a company called Industrial Economics and a woman named Chiara Trabucchi, who is doing their work with CCS risk valuation. And Chiara had been in this field, say 10 to 15 years ago, and had done some looking at that. And it worked out. She thought the risk was fairly low, but since then she has refined the model even more. And it's turning out that her valuation of CCUS risks is lower than it was assumed to be before. So I think that what we're going to find over time is that the good sites that we will be using, we're going to have a low risk valuation. And then on top of that, now I'll turn to the guys at Marsh to talk about what the market is looking like. And frankly, we've gotten very encouraging news from them about how things are shaping up.
Yeah, certainly. Appreciate that, Fred. I would just suggest, because of what we've also seen from Chiara on the modeling side, which has been generally positively received from the insurers that are participating in the space, is that what we perceived to be real about a year ago has proven to be true for the vast amount of projects that we're working on. Is insurers feel really comfortable at the risk. There is an abundance of capacity to support things like liability exposure, pollution, legal liability exposure for the sites. And we continue to find that new insurers want to enter the space, all which lends itself to lower cost of insuring the projects. But that's been the biggest takeaway, and I think a similar finding that we found, Fred. Mike, I don't know if you have anything else to add.
Yeah, I'd say that there have been a lot of misconceptions about the space in general and the availability of insurance products. I think that's kind of one of the initial headwinds we had, is I think a lot of folks were looking towards these really complex and novel solutions. And we've been able to build some there, but a lot of it has been able to fall under really just traditional insurance type policies.
So in the ability to insure these risks means that the regulatory structure, the arena that you operate in has got good definition to it. You're not gonna go out and have undefined areas and try to package it up without any kind of guardrails. Are those guardrails falling in place, or are the permitting processes happening in a way that support the work that, I mean, obviously you're comfortable with it moving forward, but I'll note that you were the first to do this. There weren't a lot of people in the beginning until you got out there and blazed a number of these trails. So you're comfortable with what you see so far.
Absolutely. I'd also say, and echo Fred's point earlier, what has resonated with the insurers is that the Class 6 permitting process is just so rigorous. That the understanding of response planning, understanding geology is effectively perfect. These organizations, despite what some may have, they have individuals with deep experience in the space, and that resonates with the insurers. Also, on the economic damages side, when we look at the modeling, it all lends itself to kind of what we supported before, which is that the risk profile and the severe catastrophic risk outcomes are fairly low. But yeah, that's exactly right, Mike. It's not to say these are insurable for bad actors. You're not going to find that organizations that are not well prepared, well qualified will be able to find insurance. But I think there is a flight to quality in the space overall. And what you're seeing is projects that are able to be approved for the Class 6 permit process are also well equipped to find affordable insurance to carry the project forward.
So one of the big pieces behind this is all these things working are necessary for a 45Q tax credit to be able to be uplifted and used, because it's reliant on it, requires it is defined by permanent sequestration of CO2 or storage. And so that brings in a whole new other element. I believe, Patrick, that's kind of an area that you've got your expertise in, is covering how 45Q as a tax credit has a certain degree of coverage needed or can be offered as well.
Yeah, that's correct. And again, and we can talk about that right now, although that's toward kind of the end
Sure. I just
of the
wanted to
carbon
kind of loop this
capture
in.
chain, because you've got the emitter, you've got to transport that carbon along, presumably to a pipe, get it to a sequestration site, and then at that point sequester it. And it's at that point that the credit is available. So, I mean, I'll tee up the issue for the group now. There is capacity in the market to handle 45Q credits, which is just the code section from the Internal Revenue Code, which it relates. So the 45Q credit is a volumetric credit. So it's based on how many metric tons you sequester during a 12-year period. You have 12 years within which to capture carbon and then sequester it in the ground. The IRS, under the tax law, can look back what we call a 3-year recapture period. So basically, there's a 15-year period within which you would ideally like to get insurance. I'm going to stop there. And I guess, Jim, do you and Mike kind of want to talk about, because there are a number of insurances that are in effect as we go along kind of the chain here.
We can always come back to it, Patrick. I think what would be helpful for the audience as we're kind of talking about this 45Q concept is one of the areas where our clients and project owners have the greatest area of uncertainty or question. So might make some sense to provide an overview of that product as it sits today. Just as background, Patrick, along with one of our other colleagues, pioneered this coverage. It's under the tax insurance world, but it's much broader than just tax insurance. So Patrick, what I think would be helpful for the audience is if you could touch on what specifically this would respond to, and then we could probably provide a little bit more detail after that. But that would be a good start.
Yeah, sure. So it's very interesting because, as you say, we're covering it's a tax risk in the sense that it is a tax credit, but yet the coverage is triggered by a geologic event, which is the impermissible escape of carbon from the sequestration site. So tax insurance, in this case, what we call 45Q coverage, will cover two things related to the credit. And that's one, that the facility is eligible to claim credit, meaning the equipment is properly designed to capture a certain amount of the carbon, and it does capture a certain volume of carbon. The second item that it covers is what we call recapture. And again, that is the idea that the service under the Internal Revenue Code can go back up to 3 years if there is an impermissible leak of the carbon in the atmosphere, and then those credits that a taxpayer had claimed are then recaptured, or then reclaimed, and the taxpayer would lose the benefit of those credits. So those are the two areas that we're insuring. It's interesting, and we'll talk about price in a bit, but as far as how we allocate pricing, most of what you're going to be paying for is quite frankly the recapture risk. And when I talk about recapture, again, that's an impermissible escape. There are a couple of permissible escapes where the IRS can't recapture that credit. And the regs refer to only two. These are non-exclusive. There are others, but unfortunately, they don't identify anything else. And that is anything from an act of terrorism or volcanic activity. So notice I didn't say earthquake, I didn't say seismic events, things like that. Unclear, but the coverage right now would cover anything that's impermissible. And going back to the pricing a bit here. So we have got recapture and you've got eligibility. Most of the cost of the policy is going to be to cover the recapture event. Eligibility is included, and it's important. It's an important item to include because the fact that we're including eligibility in what I'll call this 45Q coverage permits a number of tax insurers to provide coverage in the market. As Jim was saying, we're working with, there are two groups of underwriters in tax insurance. So you've got your traditional insurance companies like AIG, Berkshire Hathaway, who are playing in the space. And then you have what we call managing general agents or underwriters. And those are specialty underwriters that write on behalf of various people's paper, whether it be Lloyd's or others. We have a number, probably 4 or 5 that are looking to provide primary tax insurance for this space. What do I mean by primary coverage? That is coverage that provides for, say, the first 25 to $50 million of coverage. And then we would provide a layered approach where you have different excess layers of coverage. A lot of these projects are huge, hundreds of millions of dollars of potential credits a year, quite frankly. And so when we talk to clients, they're trying to figure out, well, how much coverage do we need? So first we have to say, well, how much is available in the market? And again, even though we may only have, say, 4 or 5 markets that are willing to provide what we call that primary or that first layer of coverage, remember, there are like 21, 22 tax underwriters that play in the tax insurance space. So right now it's only a minority of them that are looking to provide first loss. But in underwriters, like a lot of people in the insurance industry, it's very much a herd mentality. So if we're able to find a primary coverage, which we have, we've actually quoted a couple of risks. None have bound by any broker in this space, but we are getting closer and closer. So once you have someone who's willing to quote primary, the market will follow. We have what we think is between, say, $400 and $600 million of capacity for an individual project. What's an individual project? It's going to be defined probably as a distinct location. So if another site is 5 or 10 miles away, that's considered a separate facility. And again, we get that question all the time. What are separate facilities? So that's about what we're looking at from a policy perspective as far as how much coverage is available.
Maybe just one point, Patrick, to echo that you mentioned earlier is, although although no 45Q deal has been bound, it's not a product of the efficacy of the insurance policy. It's more of a product of the funding mechanism. Organizations aren't putting this in place until they begin to sequester carbon in the ground. It's the cost of carrying the policy. So there's a bit of a lag, and as projects advance, we think that'll change. The number of quoted deals has greatly increased. And we've also seen, Patrick, and maybe you could speak to this, some momentum in the space with decreasing pricing, more interest, et cetera, but maybe you just touch on that.
Yeah, sure. No, and that's a good point, because as a lot of these projects get closer to either operational status or just, quite frankly, financial closing, this is where we see the insurance conversation is happening a lot around 45Q. And so we do think that some of these policies, I guess I'll be somewhat optimistic and say some may bind as soon as this year or maybe first quarter next year. I mean, that's what we're seeing based on the conversations that we've had so far.
The other thing I'd say is similar to the conversation around operational insurance policies, and understand there's a question in the group from Paul. We'll answer that momentarily. Is that there is this kind of awareness of the risk associated with CCUS. We've done a tremendous amount of work to demystify misconceptions in the space, and what we're starting to see as a result of those efforts and the number of projects that are being quoted is that pricing's coming down because there's more competition for these deals. So I view that as an optimism in the space, and I also view it as kind of a byproduct of the flight to quality. Those folks that are getting through the Class 6 permitting process are being perceived by not only Marsh and others, but more importantly, the insurers, as being qualified, well-run businesses that are able to get insurance at lower rates. And I think just building that understanding, some of the work this group does is starting to pay dividends.
Yeah, and let me talk about pricing now. So just to level set, tax insurance more broadly, forget 45Q coverage. Tax insurance more broadly, as I said earlier, we have something like 22 different underwriters in the space now that underwrite U.S. tax risks. Pricing for down the fairway risks that have a supportable position being in tax world, at least a more likely than not, or a should level of comfort. We're generally seeing those prices 2 to 4% of the limit insured. That's not an annual price. That's a one-time price for typically at least 7 years of coverage under a claims made policy. That means that the insured / taxpayer has 7 years within which to make a claim. Not that the claim has to be settled within 7 years, but that a claim has to be made. As I mentioned earlier, in the carbon capture space, this is a 12-year credit. There is a 3-year recapture period. We would ideally have a 15-year policy. We are not there yet. Right now, we are at 10-year policies. pricing for that, we think the all-in cost for a 10-year policy probably going to be 4%. We think primary will be 3 to 4% of the limit insured. We think the all-in cost may be 4% or so. There are some economies of scale as you build larger programs. So when we price insurance towers, say north of 100 million, going up to about forget 45Q, but just more broadly, we have about $1 billion of capacity for non-45Q projects. I mentioned in the 45Q space, probably between 400 and 600 million. But as you get into those larger amounts, there are some economies of scale. So pricing at a second or third excess layer of coverage is undoubtedly going to be cheaper than at the primary layer. And so when I say the all-in cost is probably going to be 3 to 4%. Again, I would say on the lower end of that scale for a larger project, and perhaps on the higher end of that scale for a smaller project, because there are a number of costs that involve. I won't bore everyone with the details, but there is an underwriting fee. There are surplus lines taxes. Obviously, there's a premium, Marsh's compensation. So those are the items that go into when I say the all-in cost. So it's not like it's just the premium, it's everything. And that's what we're seeing as far as where we are from a cost perspective for 10 years of coverage. And I'm going to take a breath. Jim, any comments? I can talk about what we do for that 5-year period as well.
Yeah, we'd like you to touch on that, but I think Mike, you have a quick question.
Yeah, I was gonna say, would you just want to elaborate on what the 3 to 4% is up? And I'll just add the commentary that this is a big improvement, even just from what we were seeing 12 to 18 months ago, which is indicative of the carrier's interest in this and better understanding of the actual risk itself.
Yeah, sure. So that 3 to 4% is where we think the all-in cost will be for, say, let's just keep the numbers simple because I went to law school. So 3 to 4% of the limit insured, $100 million policy, you're looking at basically $3 to $4 million. That's a one-time payment for 10 years of coverage.
And then would you just want to touch on how you scale the limits as you build, as the exposure itself scales?
Sure. And so this is not unique to 45Q coverage. This is typical of any tax insurance coverage. So if we had, for example, a $100 million policy, we would we would find a primary underwriter. That primary underwriter would have its quote, and it's at the $25 million mark. And then we would build different layers, as I was referring to earlier, an insurance tower. So we would have maybe 1 or 2 insurers that provide what we call first excess coverage. And then we may have one that takes a $25 million slug at the top from 75 to $100 million in coverage. And again, because these risks are not viewed as binary, there is a perception in the market, and I think correctly, that there's less risk as you move away from that first loss. And again, the underlying premise being that if there is a recapture event, it's not like you're going to lose all 3 years of carbon that you had sequestered by that volume. You know, how much coverage is appropriate is hard to say. I'm certainly not a geologist and can't comment upon that. But from the conversations we've had with a lot of clients, and they're speaking with their financing parties, so their lenders and such, there does seem to be a bias toward conservatism, meaning that they're probably looking to get more coverage than would be necessary. But again, at these price points, it may behoove you to get more coverage than you need, because again, it's going to be hard to say. And quite frankly, whatever amount of coverage you buy will probably be wrong. It's highly unlikely that you'll get the exact correct amount. But again, it's about risk tolerance. How much are you willing to take a chance if there is some sort of catastrophic event like this? And I guess, want to talk a little bit about pricing. So as the markets have gotten more comfortable with this is new for them. They haven't insured this type of risk before. We're used to insuring a lot of different types of tax issues, but not this specifically. But the pricing, even in the last 12 to 18 months, as Mike had mentioned, has come down from a primary quote of, say, more like 6.5% for that first layer, remember, to more like where we're seeing this 3 to 4%. So the pricing is coming down. And quite frankly, once we bind some of these policies and there's a track record, 2, 3, 4 years where you're not going to have a leak, we think the pricing will probably settle much closer to where we see traditional tax risks being priced in the market.
Patrick, I'm just trying to raise some of the questions. We've spoken to much of this audience before, but trying to capture some of the things that are lessons learned for the audience. One of the big challenges was certainly the 10-year term and getting to 15 years. There was a concern or recognition that we didn't want to wait till the end of the 10-year period and have this risk that the insurer or counterparty here could walk away. So if you maybe could talk about what we're doing to accomplish that 15-year term on an annual basis, try to get there, while also having some certainty in the counterparty, that would be helpful.
Yeah, so we've pushed the markets to 10 years. There is very little capacity at 12. So the solution we have right now, which again isn't perfect, but it's not actually a bad solution, is at the end of the first year, bind a policy to cover year 11. Then the next year, bind a policy to cover year 12, and so on. And so that after the 15 year, I suppose, you would then have a total of 15 years of coverage. And again, the amount of coverage that you may need in those last years would presumably be less than as you're ramping up, because you should be kind of on the downslope of exposure. So that's the solution until we get, quite frankly, to market capacity of 15 years. Are we ever going to get there? I don't know. But again, we started at 7, we've moved to 10. And again, they're limited appetite for 12. So who knows, maybe in a few years we will have that 15-year solution, but we don't have it yet. So this is essentially the workaround at this time.
Yeah, and we're hopeful once we actually get to a point of finding these, that there'll be a little bit more leeway on the underwriters end to hopefully extend to that 12 to 15. But the 10 is an improvement just from where we're at 18 months or so ago.
Hey, Mike Moore, that is. We have the question in the chat box from Paul regarding what does the risk look like with respect to CO2 EOR projects? And maybe I can take an initial swing at that and then turn it over to the guys in the insurance industry, because I think that's who Paul really wants to hear from on this. But my understanding is that because we've been doing CO2 EOR in the United States for now 51 years, it has a pretty well-developed risk profile. Okay, there's a number of differences between CO2 EOR and carbon storage in a class 6 formation. One is the volumes, although in some cases you're going to have quite large volumes in a CO2 flood in an oil field. But another is the formation itself, right? In an oil formation, and Mike, I'm sure you know more about this than I do, but you're either going to have a dome type structure, or you might have an anticline or something like that, where you've got a trapping mechanism that has kept the oil or whatever hydrocarbon it may be, oil, natural gas, in place for millennia, right? So the thought that it would also keep CO2 in place is pretty easy to wrap your mind around. With respect to the formations to be used for class 6, this is where we don't quite have as much experience as a society putting things into those formations. And so the insurance industry is, I think, still developing and understanding, and that's what we're glad to hear of this great progress. I mean, I'm so glad to be on this this call just to hear what these guys have to say, even though we talk on a fairly frequent basis. But in any event, we have a track record for CO2 EOR. We don't have as much of a track record yet for class 6 type storage. So maybe the Marsh guys can talk about, how many policies do you sell around a class 2 enhanced oil recovery facility?
Yeah, I'd say that the simple answer is yes, that it's absolutely insurable. There could be some additional nuance, and I will, caveat it with that it will require the right qualifications. But as Fred just mentioned, there is a lot more historical data with respect to CO2 transport as it relates to EOR, typically pointing in a positive or in a favorable light. So definitely something that's available. One potential issue that you run into is that oil and gas can be a little bit more challenging in exposure, just falls outside of certain carriers' underwriting appetite, but absolutely insurance available. Marsh works with a number of companies in the oil and gas space. Might not be as easy, and it might require some additional data that would typically be included within a Class 6 application, but we work on behalf of Class 2 permit applications all the time for a number of our power and energy clients.
There's certainly a strong interest on the CO2 EOR part of it that has been there for a long time. One of the things it came up in a discussion last week when I was doing this talk down in Scottsdale. It's the size and scope of the expected uptake of the volume of CO2 that should go into storage, or planning to be into storage over the next 20 years, and it's in the hundreds of millions of tons. In fact, somebody did a recent work, and they're estimating that the uptake on the 45Q in relation to the expected volumes of sequestered CO2, both through 6 or 2, is going to be anywhere from 10 to 15 times the original estimates, which has a lot of implications. But if you're going to do this like they want it to do, then you're going to need all of the above. You're going to need the CO2 EOR. You're going to need the Class 6. It'll be interesting to see how that drops out at the end of the day volumetrically, and also for the how fast one is up has an uptake versus the other in the volume. But we got volumes to work with. You have a lot of geology that's been shown to be a good place to hold something like CO2. And I don't see the land rush on the EOR part like we've seen on the Class 6 declarations publicly, but I'm willing to bet that there's going to be a bigger push here as we get deeper into this game. So more of a statement than a question to the group, but more for maybe comment from your side. One would be, do you see the potential uptake of 45Q in relation to the volume of stored CO2 really being a very substantial number? And if so, what would that risk profile look like as more of this volume goes into storage, especially if it's going to be higher than originally thought? And I kind of leave that open-ended. So.
Yeah, I'm not sure who should answer that. I think the answer is, 45Q is a large inducement right now. I mean, we're certainly, well, I'll just, Mike, you and I saw it several years ago that when Congress passed the Bipartisan Budget Act of 2018 and increased the original credit from $10 a ton for enhanced oil recovery and $20 a ton for dedicated storage, up to 35 and 50, ramping up over time. We started seeing a lot of people pay much more attention to CCUS. Now that it's gone from 35 and 50 up to 60 and 85, we see a whole lot more people getting into this arena, and it's turning out to be a real driver. So what that does from an insurance basis is, I think, probably the second part of your question, but clearly a lot of these projects that are going forward, substantially all probably, are looking at 45Q as the inducement, or certainly one of a suite of inducements. There are some other federal programs that are out there and some state incentives as well, but 45Q is the main one by far.
Mm-hmm.
Right, we agree. It's the primary catalyst for all the projects we've seen. The big hesitancy is around ensuring that the 45Q credits are appropriately addressed and insured for, which is totally Pat's role. That's that product that we're speaking about. Generally speaking, from a risk management perspective, again, we just kind of similar topic. Most of the other exposures associated with these projects are largely insurable for minimal cost to an existing insurance program, or if a new JV or setup, they're easily insurable under a new program in the marketplace, but there's a tremendous amount of interest. I do think there's a bit more intrigue and optimism around sequestration from an ESG slant, as we have a number of insurers who pull back on the available capacity they're offering for traditional oil and gas operations. There is a renewed enthusiasm in the sequestration space. And for those reasons, I think you have insurers looking to offset potential or foreseen losses in the future of available capacity they'll offer and premium they'll collect, and looking to this industry in particular as a way to make up for that premium loss. So a lot of enthusiasm for these types of projects. The catalyst again is the 45Q, and most of our clients and prospects are really keenly focused on protecting those revenues, which plays into that 45Q insurance product that Patrick spoke about before, with respects to seepage or release of sequestered carbon, and also around qualifications.
Yeah, I saw, Paul, thank you for the questions. I feel like he was our setup guy here. So he had another question about how would pricing look for enhanced oil recovery as opposed to just permanent sequestration. So we've had some conversations about 45Q in the EOR space, but certainly the vast majority have been about permanent sequestration. I do think the pricing would be similar, although you do raise a good point, which is that EOR is pretty old technology at this point. It's just a matter of getting the tax underwriters who have never looked at this sort of technology, older technology, admittedly, to get comfortable with that. So I would think that there might be a slight bias toward better pricing for EOR, subject to the caveat that others have mentioned, which is that there is a little less appetite for EOR if you're perceived as kind of being in the oil and gas industry, as opposed to sequestration.
Thanks for some interesting angles on this. The size and scale of what's in front of us also brings a lot of new thinking, out of the box type thinking. I'm not sure where you see it on the insurance side, but an example is, what is the definition of direct air capture? When this was first tabled, it was machines capturing physically CO2 from the atmosphere in a machine type setting, mechanical solvents, and then the sequestration. And now we see people coming forward says, well, the plants, the plants that we grow to do certain things with are drawing CO2 from the atmosphere, or they're creating CO2, whatever. There's a different kind of construction around the capture of the CO2 part, and good or bad or indifferent. Somebody just recently was given some money from the Gates Foundation to dig a trench, bury logs, and call it carbon capture and storage. And a number of people think that's a very noble process to pursue. I'm sure that you're seeing some unique ideas that haven't gone to the marketplace for insurance, but when you have that out of box thinking on what capture might be or what carbon capture and storage might be, I'm sure that there's some interesting potential angles for future insurance products out there. I don't know if it's something you would want to speculate on. Probably, save it for others, but
yeah, I think there's a number of emerging technologies that have very interesting ideas that have not been proven at commercial scale, and what they compete against is the financial guarantee put forward by some larger providers of proven legacy technologies like the Mitsubishis of the world. And to compete, there has been some evolution in the insurance marketplace to support that, where those firms may not have well-capitalized balance sheets to go out and support the brand that they're putting forward. Some of those solutions pertain to kind of the efficacy of the product, and an insurer stepping in to provide that guarantee, if you will, around the efficacy of the technology. So it's an area where the insurance marketplace is incredibly willing to support that for well-qualified proven risks. They're very rigorous underwriting processes that everyone, I'm sure, can imagine around proving the technology, and then an insurer putting their balance sheet behind that risk, subject to certain limits of caveat.
Sure. I think you bring some very, very strong points here about how this may play out. We can go out as a group of individuals and make some investments that are maybe large by an individual means, but maybe not the commercial scale that makes much of a big difference. That it is not something that is going to be for the faint of heart, for somebody that doesn't have a long-term goal or a long-term play and doesn't have the capital capacity and a strategic role to play in this. So insurance is going to be available. It's going to be available, and I think your words were for the qualified people. That, you know, like MHI, for example, they're when you're building a CO2 capture project, lots of new technology to look at for physically capturing the CO2. But probably from a funder standpoint, he's going to be very comfortable with somebody that's been around for a while. My guess is that's going to be the same with insurance as well. You're a trusted name in the market space. You've tried and true in the processes that you guys have worked on. So we may see some people that come into the game in a new sense, but not have the capacity that Marsh would have. They've become the MHI of the CCS insurance world.
Yeah, I think that's exactly what the point of the webinar was when we discussed this previously, Mike, which was just looking at ways to try and assist with project enablement. I think it's a little bit easier when you've got the massive balance sheet and can retain a significant amount of risk, but there are a number of products out there for the balance sheet protection piece. 45Q, Jim mentioned the efficacy insurance, which has been a popular avenue to bring credence to the technology for the different clients that we work with. And then a lot of it just comes down to what type of contractual guarantees you put out there and making sure that you've got the right wording and verbiage in place. And that's where Fred kind of comes into play to ensure that you're taking on as little risk as possible.
Yeah.
Hey, Mike, couple things here. One, there's a question in the chat room that we might want to get to. I guess there's a couple of them in there, but I also wanted at some point, maybe before we turn to that, a lot of the concern that we have heard from folks over time is, what I'm worried about is long term. Okay. Once I'm done with this facility, I'm done injecting. Okay. I don't want to be hanging around for, hundreds and hundreds of years having to worry about this facility. Right. And so I think that's the issue that's got a lot of people thinking about this. A wise person told me and asked me, turned the question around to me a number of years ago and said, well, name me an industrial activity where, people are getting rid of waste and really don't have to keep worrying about it for the long term. Is this really any different? I think what we've been talking about with Marsh so far largely covers the operational phase, and in the question of the tax credit issue, really the tax credit term, and we haven't, the market hasn't quite gotten to the recapture phase yet, right? But the 3 years after that. But maybe we ought to talk just briefly about the long term and versus the operating phase. I'll lob in a little bit there, and maybe the Marsh guys can comment on this too. But I think generally what is expected is that for a long time, as people have looked at this, they've looked at risk as a function of underground pressure, right? That you're going to be pumping in a lot of CO2 into a formation, and the pressure will drive risk because the pressure is what causes the CO2 to be mobile in the subsurface. And so long as it continues to be mobile, there's at least some element of risk, but I think we all expect that to diminish over time, right? Because as the CO2 is in the subsurface, the scientists will tell you that CO2 will mineralize. And as it mineralizes, not only does it cease to become mobile, but it also forms a barrier to other CO2 in the subsurface that hasn't mineralized becoming mobile, right? So So in any event, there's that aspect of it. The other aspect, I guess, is just simply the rapidity of the decline. I think that's going to be an issue that varies by facility based on years of reading literature on this. It's really going to depend on the geochemistry and other factors. But I'd be interested to have the perspective of the Marsh guys on that question in particular, the long term.
Sure.
Yeah, it's created a lot of excitement. I'll say the topic of long-term liability over the past several months. We have the same perspective based on the modeling we've reviewed as you do, Fred, and that the risk of a release event, because what happens to the carbon, the crystallization, mineralization of the carbon over time becomes lesser over a period of time. For the same reasons, all supported by the science, we think that tail exposure is largely insurable in a long-term pollution policy where we can put in place for a period of time to kind of capture that risk. The other area that we see a lot of excitement or maybe misunderstanding is this role of certain states with periods electing the option to take over a site under the long-term care, and it's perceived to be a responsibility of the state. And that's obviously created a lot of excitement, but we do perceive it to be an option to take over. Most organizations that are sponsoring projects understand that we're only as good as the last project incepted, and the whole industry could have a setback for one bad actor. So for those reasons, we see a lot of organizations pre-planning for that long-term liability, establishing what they may do, like a long-term or tail pollution policy to cover that event. Obviously, post-operation, there isn't a ton of concern because there isn't the recapture risk that Fred, you alluded to. That 45 recapture risk ends at kind of the operational stage in 15 years, 3 years after injection. So we're really talking about what the risk would be, which is long-term release of the pollutant that causes any third-party bodily injury or property damage. And again, that's what we feel we can cover under a pollution legal liability policy with a tail component. Mike?
Yeah, and I just wanted to point out that, I mean, the Class 6 permit application is a very rigorous process. If you take a look at the graphic included within the Class 6 guidance, the Class 6 permitting guidance issued by the EPA, it requires you to specifically point out each aspect of the project and how you're going to fund from it from a financial assurance standpoint. It does not require anything for long-term liability. And I think that just demonstrates that they don't see a massive concern. I think that if there was even a little bit, it's probably something they'd require further guidance on or funding. But ultimately, it's something that we point back to, that looking at the modeling, looking at where the science points, that there's not a ton of risk, but it's something that there should be insurance readily available for long-term. And we would assume for a lot of the companies operating in the space, it's just something they can continue including within their environmental liability policy on a go-forward basis.
It's totally right, Mike. And there was a question in the chat around just because we're on the Class 6 permitting process, the rigorousness of the process in states that have primacy or taking control of the application process. From our experience of working through the permitting process, they've been as rigorous as the EPA with stringent requirements. We don't feel like there's been any steps back or deterioration of a very detailed review process for states that are taking over control of the permitting process. In our opinion, it's equally as rigorous.
Yeah,
I think that's a requirement of primacy in general, is that the requirements be as rigorous as it would be if it was evaluated by the EPA. I will say just one thing to caveat with some of these primacy states is they will have the opportunity to issue their own guidance and preferences. One of them, the state of Louisiana, is requiring environmental insurance for the emergency and remedial response. So just something to keep in mind as you guys begin looking at these projects, that from a Class 6 permit application on the financial assurance, it's kind of have a little bit of flexibility and put some thought in it prior to the 11th hour when submitting the application.
Yeah, one thing on the primacy issue, I think it bears noting that in the resource development states, almost all of those states already have primacy for class 2 injections. Class 2 is the oil and gas category. So I guess you could say, in a sense, that the states that are likely to be doing CCUS, at least the ones that are likely to be doing it first, already have the greater experience in this probably than the EPA does, because they are running the class 2 program, which is perhaps it's less robust, but nevertheless, it's a very close analog to class 6. So I don't anticipate a big concern about lack of capability in the states. So one other thing, back to the long-term liability issue, Mike, that bears some mention, and we've had this debate within the CCUS consortium. We did a symposium last December with Marsh, where this issue was brought up by one of the panelists that we invited, and we knew they would bring up this issue. But and that is that some states, about a handful, have enacted state laws to take on the long-term liability themselves. Now, as we have, as I laid out at the beginning of this, as we've learned more about CCUS, gain more knowledge about it, we think that risk is relatively low, and it may not really be necessary for these states to enact these laws in the long term. But frankly, if they want to do that to encourage CCUS development within their borders and sort of take that concern off the table, I don't see any problem with that at all. There has been a criticism out there that essentially goes that, well, doesn't that really take the it doesn't really take the incentive off of the operator to do a good job, and off of the state to make sure that they are overseeing it, administering the program, so that we know that CO2 is being well managed at each facility. I would say no, it does not take that incentive off. The operator is going to be responsible for quite a long period of time, so they have an incentive to do a good job, because they're going to be on the hook for quite a long period of time. It's only after they're done that the state would step in. I think we do prefer that the private market, we ought to just prefer, just as a matter of efficiency, that the private market take this on. But the state has an incentive then to do a good job to make sure there aren't any problems with these facilities, because if they're left holding the bag in the long term, they want to know that those sites have been well maintained during their life. So because
Fred,
that's a policy issue that's been out there, I just wanted to bring it up.
Sure. Fred, and this goes back 10, 15 years ago, conversations we had as this was evolving and beginning to surface. Yeah, a state comes in and does this work, and there's an issue with an earlier sequester. The state's not going to just go, oh, geez, thanks for leaving your CO2 with me. They're going to look for remediation for the issue they got themselves stranded with. They've got legislators and a public that will tell them to, pursue where there's an issue. So I don't think that's a misconception that it gives an actor kind of an opportunity to be less focused on getting the work done well. The other part is the size and scale of the market space that's uploading CCS was kind of contemplated, but it was never envisioned to be as large as it is today. And of course, that's in part from the 45Q tax credit. You're not going to get the 45Q tax credit unless that sequestration part has been followed rigorously. So you have a lot of stopgaps, even if a state does take it over. I think I'm not an attorney, never professed to be, spent a lot of time around guys like you, but guys that have the capacity and the capital to do these large scale projects typically are around for a long time. They don't come and go. So if a state is caught in the middle of something, it's going to look long and hard at who its partners have been getting to the place where they're at. So there's that interest in deep pockets, and we've seen this in other industries. And so there's going to be a certain tension there to make sure that whatever you do for the long haul is going to be done well, because you don't want to look back 20 years or 30 years later. And it's but the dynamics of the size and scale of this are pretty cool. The state's interest to do this, to the preservation of jobs, the distribution of wealth and opportunity to down to the disadvantaged areas. There's a whole lot of beneficiaries from the state's perspective if they step in and encourage an industry to stay that would otherwise might have left.
Yeah, I would say if the state, and I have looked at all the state laws that have done this. I don't have them committed to memory today, but to the extent a state is considering a law like this, I see it as perfectly reasonable that they have a requirement in there that before the state's going to take long-term stewardship, that the site be shown to be in good shape, that the operator should have discharged all the things that were required of it in order to get a clean bill of health, right?
Wouldn't the state turn to Marsh and say, listen, I need a backstop? I'm going to take all this risk on. Can you give me a little hedge here? You know, so the insurance product, whether the state is involved or not, is going to be a in-demand product for all parties involved. I can see where, you know, the state of Texas reaches out to Marsh and go, listen, we might do something like this, but you know, we probably need a little bit of a hedge. What can we do as a statewide hedge with you guys to dissipate this risk over a wider field? Something to that effect. I don't know. I'm that's your world, not mine. But you know, it's you hear lots of fun talk when you sit around a conference and it's over and people are kind of loosened up and having discussions. We've got a couple of questions. I'd like to just kind of catch them because, you know, we're over the hour. It's going to be easy to get to the an hour and a half. And I think that looks like we've covered. Paul's got one other question in here. Similar to the guarantee for the efficacy of the technology, are there any insurable products available to cover a sink's obligation to receive and inject the volumes of CO2 they have committed to, i.e. take or pay obligation? And that's probably an operational.
Yeah, I'll take that one, Mike. At the moment, the short answer is no. Mike and I had a conversation with a few key insurers in the space out of London. There is some interest to support some areas of that. I doubt at the moment it'll be as fulsome of coverage that will really respond to kind of the needs of a lot of folks. The best remedy for that type of exposure has been around contracts and contract penalties that we've seen at the moment, but there isn't a true insurable product available to address all of that risk. Obviously, if the reason for the failure to kind of provide the carbon is due to some type of physical loss, that would be covered under a business's potential business interruption coverage under property insurance. But absent like physical hazard, physical loss, more economic related damages or effects that impact the ability to provide CO2, there isn't a real insurance solution for that at the moment.
Probably could create something, I bet, like with a fair amount of work, and it probably wouldn't be cheap though.
That's our
Trust-
goal. Yeah, Mike.
Trust me, we've chased it down. We've got our parametric solution team. We've looked into surety. As Jim mentioned, the conversations across the pond in London right now with some prospective insurers there. So we're definitely trying to chase it down as we know there's some demand for it, and ultimately just looking to support project enablement.
Yep. Well, it's kind of like selling firm in the early days of selling firm power in a power market that had no upside or no upward bound limits, and there was no way to cover with an offsetting transaction because of how thin the markets were at that time. So something to that effect. Sahar Bakshian, and I'm sorry if I worked your name over the wrong, but you have a question here that kind of goes back to some of our early discussions, but still pertinent. What is your approach for quantifying the risk of leakage through legacy well and the costs associated with it? That's
Yeah,
you'd probably turn to the work of folks like the Bureau of Economic Geology or Battelle or others, and maybe some of the corporates that have done work on what these legacy well conditions might present.
I think that's exactly right, Mike. I think not all wells are created equal. I think ultimately the types of carbon being sequestered, the specific geology, those are all going to play a role. But there's a lot of firms that work on economic consulting. Fred's mentioned Chiara, who does a lot of work in the space. They are the experts in the space. We, in many instances, rely upon their data and kind of validate some of our own understandings with that. But there's deep models and firms that have that modeling capability to support that area of risk.
Sure. And you have Sue Havorka, we all know well. Hello, Sue, glad you're participating with us. You spoke about the amount of about the main risk for which is a project needs insurance is recapture after loss, but you do not consider the damages, i.e. to the water, surface, or other resources to be a significant risk. And there's a question mark after that. Are you not considering that as a risk, or where do you see that in addition to just the recapture, the credit itself?
The recapture being a primary risk is related to the 45Q tax piece. There's definitely a risk around the environmental front, as we've kind of noted numerous times throughout their economic consultants that can help value what a loss would be there. But those are definitely the two biggest drivers and kind of potential risk areas that we see, which is going to be on the environmental front, whether it be property damage or bodily injury.
Yeah, I think it's a comparison of significance. I think the failure to capture and the recapture risk, those are losses on the hundreds of millions of dollars as compared to when we look at loss estimates on the damage to things on the environmental side being far less than the tens of millions. So when organizations think about that, they can offset that risk by purchasing an environmental insurance policy that will cover those risks. It's not to say they're not, concerning or significant. I just think the comparison of what's most entity threatening and most significant in terms of the risk, it's the failure to recapture. And it seems to get the most significance. The environmental policies in terms of limits, we talk about magnitude of significance and catastrophic loss of being in the tens of millions. The premiums for those policies are in the tens of thousands. So very affordable insurance policies, which speak to some of what we've already shared, and that not only do we perceive the risk to those natural resources to be fairly low, the insurance community also has a similar position on the risk.
Well, you guys, from the just the experiences with oil, gas, and other resource recovery processes, there's a relationship with insurance that goes back centuries. I would venture that there's a lot of experience with resource management.
Yeah, and candidly, most of the underwriters that will support carbon capture and sequestration, these are insurers with deep experience in oil and gas.
Sure.
These types of projects, I don't mean to minimize the risk, but these will be the easiest projects they insure for. In their own words or perspective, not just mine. But this is kind of perceived as the easy stuff in terms of a risk spectrum. There's some crazier things out there when you look at nuclear facilities that really keep these guys up at night. It's not the CCUS piece, which is, again, when we started talking about a year ago, hopefully resonates when we told a lot of project owners these are highly insurable. That's come to fruition. Folks have found environmental policies that are surprisingly inexpensive to support these projects. So it's one of those misunderstandings that's really come to be true. It's very insurable, and there's an outpouring of interest in the space.
Sure. I can think of some times when we were working on CO2 storage risk issues from a legislative standpoint. We had a couple of different camps, and one was touting Price Anderson as a route to take, and the other one was a tariff on top of any kind of CO2 molecule that was commercially moving around, and just created a lot of internal industry anxiety as well. But it was interesting because it was put right up there in the same category as the nuclear risk factors. And yet to hear you from the industry to say, yeah, this is we can do this. There's other scarier things out there that will bother us. This is something we can manage. Fred, I'm gonna, because we'll take it to the 4:30 mark. You're in the middle of this up here in DC. You've got, between yourself and your own network of partners at Hunton, Andrews, and Kurth, you get to see and hear and participate in a lot of things. What would be for carbon capture and storage, carbon capture utilization and storage, and the work that's going on for the Class 6 permitting? Is there something in the woodwork in front of us that might accelerate? I mean, permitting has got to be the single biggest hamper right now. Is there any chance of a breakthrough on that?
Yeah, so it's interesting, Mike. Let me go back a second. You were mentioning Bryce Anderson. I actually did some work years ago on risk management, and we looked at Bryce Anderson as a model for managing risk for CCUS, not to equate the risks associated with storing CO2 with nuclear in any way, just simply that it's a useful model because it's one that the government has used previously. For an area where there was an emerging risk that people didn't really fully have their arms around. I think we now have our arms around it a little bit better than we did even 10-15 years ago. But in any event, so what's emerging? One thing that we really don't hear about, let me just get this out of the way first, all that much on the policy front right now. By that I mean legislation, regulation, is risk management. Okay, I think people feel like that's a relatively settled area right now, except for what we talked about previously with the states taking on some of the long-term risk. But permitting really is the big issue right now. We, at the farm, and I don't know, many people, probably a number who are on the call today, know who Sally Greenberg is. Sally and I were at a conference last year of the CCUS commercialization consortium, and she said, geez, I wish there were one place where you could go to find out all the permits that are out there. And I said, well, EPA's got that site set up. And she said, no, what about all the states that end up getting primacy over time? And I thought, well, geez, that's a great thing. Why don't we just go ahead at the law firm and set up a tracker for that? So we have done that. So right now we've got the EPA, the ones that are the permit applications that have been filed for Class 6 with the EPA, those that have been filed in Wyoming and North Dakota. And you can Google, or you can, search for that online. It's Hunton Class 6 permit tracker. We've got all that information on there, including the primacy applications of the state. So right now there are, I think the last number that I saw was about 75 permit applications, Class 6 permit applications out there that are pending, I think, at the EPA. The EPA has, in the years of administering the Class 6 program, approved permits for 2 facilities. It's more permits than that because of the number of injection wells, but for 2 facilities. One of them is ADM's Decatur facility, which is still operating out in Illinois. The state of North Dakota, which has had primacy in the state since 2018, has already permitted, I believe, 4. It could be up to 5 now. I've been told by folks in North Dakota that they've got 7 or 8 that are in the wings that they're working on. So in rapid order, they've already outpaced the EPA as a whole, but in rapid order, they're going to far outpace the EPA. This is the thing that people are concerned about the most. Are we going to be able to get permits for our facilities? I think the sooner we get primacy out to qualified states, the better that's going to be for speeding up the permitting process. The EPA, I have heard through the grapevine, would like to have more people internally to do the work of reviewing both the permits and the primacy applications. So maybe that's a resource issue with which Congress can help. I do know that Congress is frustrated with the pace of approving primacy applications. The House of Representatives and the big energy / permitting bill that they passed maybe a month or a month and a half ago put in an amendment to put a firm deadline on EPA approval of primacy applications. If they don't get it done within a year, and the state, really on a facial basis has all the qualifications to get primacy, then the application shall be deemed approved. I know the Senate is that's been proposed as part of the Republican permitting bill in the Senate that Senator Shelley Moore Capito has introduced. So we'll see if that ends up happening. I think there's certainly a lot of interest in getting this going, and I think if it takes that to make it happen, then by all means we just need to make it happen, because otherwise this is not really going to happen as quickly as we want.
Well, we've got with 75 permits in the hopper that you're aware of that you guys are tracking. Any rough estimate how many millions of tons of CO2 those if those wells are permitted, would be capable of being sequestered? Is there a way to extrapolate that from that, or is that kind of really not?
I have not done that. I did, just before this, speak at another conference on a similar topic related to CCUS, and one of the organizations that was on the panel said they are tracking applications that are in the realm of 250 million tons per year. Right. So that's a very significant amount. So that's all I can say. I don't know if the filed permits come to that level yet. That may be some projects that haven't put permit applications in yet.
So we really do have the size and scale that's been talked about coming at us. The veracity of the players are high quality, well capitalized. I mean, there's a lot of others that are taking a shot at it, but there's a lot of big names like the people that are doing the pipeline networks with the ethanol, CO2 source points. And there's others. And so the permits, the size and scale, the projects, the veracity, the participants, the desire of the states to have the primacy, the number of permits that have been uploaded at this stage, the work in Congress it's all encompassing now. We used to be little segments, little pieces on the side that were fun to work on, but they had bigger fish to fry a lot of times. And now this is all front and center. So, for Marsh, you guys are right smack dab front and center in the thick of it. Fred, I know you and your partners are also right front and center in the thick of it. And we all know a lot of people have taken a shot at it. It's going to be fascinating times. And Patrick, with the work on the 45Q, the potential volumes of 45Q tax credits that can be issued out there is almost a little bit mind-boggling.
Yeah, it really is. When you hear, we have so many of these conversations weekly and monthly, and yeah, it's incredible the scope that these projects are going to have. And again, I think over time the capacity of the market will increase such that we'll be able to accommodate them, but we're certainly not there yet.
Fascinating times. Well, I'm looking here. Unless there's something somebody would like to add or to close this out, Mike, Jim, Patrick, Fred, some parting thoughts, hey, look over the horizon, or last words to kind of wrap up an hour and a half here.
Well, I wanted to say thanks again, both to the U.S. Energy Association and to Marsh. Mike, you've asked me to speak several times here. And on this one in particular, I felt like we need some fresh blood. We need Marsh to come out and talk about what's really going on in the market. I didn't feel like I had a whole lot new to say, but again, the audience is growing so much in this arena that maybe some of what we've been working on for a number of years really is new to a lot of folks. So thank you for the opportunity, and I'm really encouraged about the prospects for CCUS.
Right. Well, I think we're certainly seeing it here at this site as well. I'll tell you what we'll do. It's not quite 4:30. We went a little bit. We went past the 1 hour mark. We're going to wrap up right before the 4:30 mark. I want to say thank you, gentlemen, for taking the time out of your busy schedules to be here today, and also want to emphasize that this is recorded. So the content is available on our website. It's public domain in a sense. So for people that didn't make it today and you want to get it to them, you can take, once we get it uploaded, Michelle will give us a heads up when that's done, that send it around and repost. There's a lot of content here. I think for the people that we're on, that they're keen in this space would agree. And I think that the people that have not seen it, that will see it, will agree. There's a lot of good frontline insights here. And again, gentlemen, thank you very much for your time. Michelle, thank you for helping us get this going today. And have a great rest of your week and knock out lots of insurance deals.
Thank you, Mike.
All right,
Thanks,
gentlemen.
everyone.
I'll have a great one. Thank you. And one last part, webinar, May 23rd, de-risking CCUS and the technical side with the Battelle Group on our USCA website as well. So segued into that. Have a great one. See you all soon.
Thank you all.
Thank you.